guys, I'm trying to get this video rolling. My brain is not woken up for the day, which is a little concerning. It's 2:29 p.m. Um, I don't know. I've been really excited about this video, but then it's like sometimes you turn on the camera and you're like, you can't even think logical thoughts. So let's get into it, guys. We are going to be going over 3 rules I have and I stick to in order to outperform all major indexes. That includes the S&P 500, the Dow Jones, the NASDAQ, and the Russell 2000, guys. Let's get into it without further ado. Real fast, we will go over the performance of the portfolio. Today, I'm up, $394. 1 year change. This is not 1 year change. This is since May 14th, I'm up $17,000. Okay, that is reflective of almost a 31% upside. And I do need to include like a big disclaimer. This is not reflective of my investment performance. Okay, this 30%, that looks awesome. That's exciting. If I can compound 30%, every 8 months or so, then that's going to be, that's going to be great for long-term performance. However, this is not reflective of portfolio performance because it includes, money I've invested, okay? It includes contributions. So in order to get the full story, I know some of you guys be calling me out sometimes, hating. We go to portfolio performance, this tab here, and we can see we are going to use a few of these resources. Over here, we have value versus net contributions, okay? So this beginning value on, again, May 14th, 2024, that's when my TD Ameritrade account became a Schwab account, is $55,629. Net contributions since May, I've contributed $7,650 into the portfolio. That's pretty interesting. I didn't know what the estimate was, but it's good to see it all, laid out like this. The investment change has been $9,252.30. Okay, so this investment change here is gains on positions I have. This number here, net contributions, net new capital I've put into the portfolio. Okay, does that make sense? And this investment change is going to include dividends, as I am a dividend growth investor. So with these two, contributions and investment change, it takes me from that 55K to, the 72.5K, which is an all-time high. So, we'll look at this real fast. You can see a lot of my net contributions came here in, this stretch from September to late October to early November, okay? That's when a lot of my contributions were made, and the reason for that is, that's when I was making the most money at work. I had the most capital left over, and I think I've kind of gone over that, and the channel's been very reflective of that, okay? During this time, I was doing a lot of the $1,000 buy videos, Monday morning, extra grand, I can throw it in the portfolio. Let's not get on a tangent. Point is, I've continued to add capital through, all walks of the year. Okay, does that make sense? Whether it's only $100 1 week, $50 1 week, whatever it is, it's very important in this game to stay consistent, guys. Now we'll get into the actual fun stuff. And this right here, this rate of return, is why I can safely make the claim that I've outperformed the S&P 500, guys. Let's get into it. So this rate of return is going to show, more of my true return from the portfolio. We will quickly review how it's calculated, and it's going to be very similar to kind of this visualization, okay? It is calculated, okay, let's see, Alex's portfolio, yada, yada, yada. The account value has risen to 12.5K from 10K. but he has also invested 5K, okay, resulting in a new value of 17.5K. End of the year, the account value has risen to $20,000, okay? When we calculate Alex's rate of return, we are not including this $5,000 investment, okay? And the way that it's going to happen is there's going to be a sub period, okay? The period of the 10,000 performing to the 12.5, that return is going to be calculated. And then when the new capital goes in, the contributions are going to be stepped up. Does that make sense? And there's going to be another sub period to calculate the rate of return, okay? It's a lot of interesting math. And as you can imagine with my portfolio, it's going to be much more complex than just this example. But the bottom line is this. Your return in between contributions will be calculated, so your contributions to the portfolio do not affect the overall picture, okay? It's the only fair method of doing it, okay? So my rate of return from May 14th, 2024 to February 26th, 2025 is 16.28% for my portfolio. What is the S&P 500 for that same time period? 15.3%. Okay? Does that make sense? I have outperformed the S&P 500, by a full percentage point during this period. Okay? I know this is a shorter period, so we will have to stack this up over time. But, that's another story. Russell 2000, rate of return, 6.54%. No competition there. Dow Jones Industrial Average, 11.75%. I have outperformed it as well. And, unfortunately, NASDAQ rate of return is at 17.05%. I have slightly underperformed the NASDAQ in this same period. But I do want to mention this. Mine here is this blue line. Okay, we'll take off the Russell and the Dow Jones because that's extra. So I got on yesterday and I had outperformed everything. So, just in the term of from yesterday to today, now the NASDAQ has a slightly higher rate of return than me. Oh, well, we're not slowing up the video. Now that we have gone over, the performance, now that I've proven I have outperformed the S&P, not just with contributions, but with performance. Let's get into the 3 rules I used in order to outperform the market. Guys, number 1 is going to be hyper selectivity, okay? Being hyper selective of the stocks you choose to have in your portfolio. Okay, I put here diversification killed the cat, okay? This is a fairly simple concept, and I want to explain a few of these concepts in pretty layman's terms. You know what I'm saying? The more holdings I have in a portfolio, very intuitively, the closer my portfolio will perform to the average. Does that make sense? So if I have 1 or 2 amazing stocks in my portfolio and that's it, it's very likely that I will have outperformance. Okay, with that being said, if I put in more and more stocks in the portfolio, the closer I become to average and the worse off I become. Okay? And just to further drive this point home, I want to bring up a common misconception to, stock market investing, and it's this. I think beginners, or when you're starting out, you kind of have the notion that if you pick a stock, it's got a 50% chance of outperforming and a 50% chance of underperforming. Okay, that's the misconception. That is actually not true. And the reason for that is because a lot of the large, high flyers, the best performing stocks, they carry the index with them. Does that make sense? So according to Schwab, only 17% of S&P 500 members have outperformed the entire S&P 500. Okay? So with that in mind, if only 17% of stocks are outperforming, the more diversification I have, the less likely I am to hit those winners, those outperforming plays, and lock them in, at the right cost basis. To further illustrate this point, I do want to show you guys a way I have learned to wrap my head around it. Okay, and it's the it's the concept of an S&P 500 equal weight index. Okay, so the ticker we'll be using is SPXEW. S&P 500 equal weight. Okay, we're gonna take a look at how this performs in comparison to the S&P. Okay, so right here, what do you guys think? Okay, we can see in the past year, the S&P has returned 17.49%, while the equal weighted S&P has only returned 12.8%. This may seem like boring stuff, but these are very important concepts to understand. These are very important dots we need to connect, okay? The S&P 500 is not 500 stocks performing. It's not like that, okay? It's really only the top dogs, the best performers making up for, a large chunk of their performance as compared to, the other 493, okay? Does that make sense? Okay, so just to review, that's rule number 1 is being hyper selective. Okay, moving on, guys. Rule number 2, I'm not really going to use data or as much illustrative concepts for this, but I am going to say it and I am going to stand on it. It's going to be this: do not, for any reason or circumstance, use a dividend reinvestment plan. Okay, and I know maybe there's other YouTubers who talk about, turning drip on to speed up compounding. I am not that guy, okay? To me, this is a fundamentally incorrect way of thinking, okay? And as an investor with conviction in your ideas and your plays and positions, there should be no distinguishment made between, net new capital and dividends. Why? Because they're both cash. They're both, dollars that I can use to capture opportunity. Okay, so this whole notion of, buy this, turn on the reinvestment plan, set and forget, I believe it's fundamentally wrong. And in order to illustrate that, I think it's best if I pull up, maybe an example. I know this is kind of a go-to example I've used on this channel, but we will use Altria. And so like I've said, I would not turn on dividend reinvestment with Altria. And here's why, okay? So as you can see, I've built out this Altria position over the course of the past, roughly 5 years, okay? I've been very selective to lock in a good cost basis on this one. And I've been very selective at buying in opportunistic times, okay? Does that make sense? This has led me to a cost basis of $44 and change. Altria is currently trading at $55, okay? A lot of my yield on this one is nearly a 10% yield on cost. Does that make sense? So with Altria, essentially, I've bought dividend income at a rate of 10%, okay? I've been very opportunistic, buying dips, whatever, whenever I can, and kind of, keeping this one on my watch list, staying updated with it, and it has rewarded me well, okay? I have a great average price. I have almost 3,000 in gains on it, and it pays me over $1,000 a year in passive income, okay? This did not happen by accident. This did not happen with a dividend reinvestment plan. This happened through opportunistic buying, okay? I use Altria as an example. If I had a dividend reinvestment plan, all that would do is, lower my cost basis and lower my yield on cost on it and take away capital that could go to more opportunistic guys, okay? I love Altria. I love it in my portfolio. But as you can see, I'm not buying this one at 55 right now. Okay, I was building this one out in the low 40s. Positions built out. I'm done with it. I have the dividends coming in and I'm moving on. Okay, I'm opportunistic with it. And, I said under no circumstances should you be using a dividend reinvestment plan. But I think it's fair, if I say maybe the one and only exception that I ever think it would be. I don't think it would be justified, and I personally would never do it. But if there was going to be one exception, it would be this. It would literally be you're truly just a set and forget investor. You kind of just want to put money here and let it compound and completely take your eyes off any fundamentals, any charts, news, anything. You just truly want to be a set and forget investor. Okay, I could see using a dividend reinvestment plan. But to me, that's almost a form of laziness. Okay, and the reason why I say that's laziness is as a dividend investor, it's kind of a slower moving portfolio management game. It is not something that takes, hours every week. Okay, it does not take as much time as some other styles of investing. Okay, it doesn't take as much time or due diligence, and that's just the cold hard truth. So, if you can't handle keeping up with your portfolio, I think that is laziness. Okay, I would venture to guess though, if you're on YouTube or whatever you're doing, you're here, you're interested in managing your own money and doing it, for yourself. Okay, guys? So that was rule number 2. Do not use a dividend reinvestment plan. Okay? So number 1, hyper selectivity. Number 2, no drip. Number 3, okay? And I'm going to get backlash for this, but my thing is this. I started this YouTube channel to preach my style of investing, to preach what I believe in and what resonates with me. So that brings me to rule number 3, no ETFs, okay? And we will get into the why. But I do not think as a dividend investor, you should be using any ETFs. You guys guessed it. I'm going to be using SCHD as kind of my example to refute my idea to refute. Hang on. Okay, I'll be using SCHD as an example to refute the idea of using ETFs for dividend investing. Okay, I would venture to say that SCHD is the highest quality dividend ETF. I think that's a safe claim to make. And I think the majority of dividend investors who use, ETFs would have to agree with me. You can't really look at one dividend portfolio on YouTube anymore without one of their top holdings being SCHD. But let's get into why I would strongly caution you against using this method. Okay? And like I said, we're going to go through a few things. SCHD is probably the best example, but number 1, fees are unacceptable, okay? The point of dividend investing is to have money coming in that I can compound, okay? Have capital coming in, use that capital to buy other positions that generate more capital, okay? It's the name of this game. It's a dividend snowball, okay? It's a very popular term. We've all heard of it, a dividend snowball. If we have fees coming in, hitting our account, that's like someone walking up to our snowball or snowman that we're building and taking some off of it. Even if it's a little bit out of the snowman, it's going to tick me off, okay? Does that make sense? So even with SCHD, very small expense ratio, I would still say fees are unacceptable. I preach this, as we're compounding, let's keep our capital in our portfolio unless it's absolutely necessary. Oh, I don't have enough money for rent this month. I'll use the dividends. Okay, that's okay. I understand life happens. So, I want no fees in my dividend portfolio. I'm not going to reach Outperformance if I'm always paying fees, no matter what they are. Okay, and I do also want to drive home the person or people getting the wealthiest from SCHD is Schwab. Okay, the people making the real money from SCHD is Schwab, taking that fee off their, immense portfolio of investors who invest in this one. Okay, but let's move on. And this is another fairly simple concept. Okay, I'll pull up the chart for it, I guess. But I think it's something that can be explained, and I have owned SCHD before for like 3 weeks, then I snapped out of it. Busted. Okay, you got me. Okay. That's really not a good look. But, I won't do it again. I realized it wasn't for me. It took me 2 weeks. Okay, my bad. Let's just say this. And what I want to say here is when there's a buying opportunity, whether we're looking at charts, whether we're looking at... Sorry, I had to pause for a second. So if SCHD looks like a buy, whether we're looking at charts, whether we're looking at valuation metrics, I understand for ETFs, price to net asset value, regardless of what method we're using to determine that SCHD is a buy, there's always going to be a better buy within the holdings of SCHD. Does that make sense? So let's review the holdings of SCHD. Here's their top 10. AbbVie, Coke, Amgen, Cisco, Pfizer, Verizon, TXN, Bristol Myers Squibb, Chevron, and PepsiCo. As you guys know, here's an example here. I've been buying PepsiCo hand over fist. I've been adding to Pfizer. Do you see how, let's say SCHD, seems like a buy to the average dividend investor, where I come in seeking that outperformance is, I'm kind of picking stocks that maybe SCHD holds that are better opportunities right now, okay? And this kind of goes with my hyper selectivity. If you're buying SCHD, all you're buying is, a small allocation of 104 stocks and taking, a small expense ratio for money management. I don't think that's what we want to do. Let's look back at the chart again. So we look at SCHD. Maybe it's a buy right now on this little dip, you could say. But where I come in is, okay, no, I want better opportunities. Okay, I don't want a family of stocks. Okay, no, I'm looking at Pepsi. I think Pepsi is a great opportunity right now. If I bought SCHD, I would get that Pepsi exposure, but not as aggressively as if I just built out this position, cash in Pepsi shares. Does that all make sense, guys? I'll put it like this, and then we'll kind of wrap this up. What you're doing in this game as a dividend investor, you're essentially building your own dividend ETF. Okay? You're not paying an expense ratio because you are the asset manager. Okay? Does that make sense? Because that's I think I really just hit the nail on the head with that one. Okay? You are Schwab creating SCHD, except it's not SCHD. It's your own group of dividend stocks that fit your risk tolerance, that you can sleep well at night with, that you've determined position sizing, and that you've had the conviction, to build out these positions. That's the name of this game. Okay, guys, thank you for staying with me today. And I'm going to leave you with this. Believe in yourself, guys. Learn from this game and commit. Learn from your mistakes and commit to this game, guys. And you will reach that outperformance. Even right now, I'm just slightly outperforming. I'm going to make this video again in a year, and I guarantee my outperformance is going to be even better because I've made more mistakes, I've learned, and I've continued to grow. Don't take the easy way out, of just buying ETFs. Don't take the easy way out of reinvesting your dividends, plowing them back into the stocks they came from. And don't take the easy way out of just overly diversifying. Okay, guys, and you will reach that outperformance. Thank you for tuning in today. And if you're not subscribed, please subscribe. We are going to become, and we are becoming, the best dividend investing channel on YouTube, guys. Thank you all. Let's build wealth.